Welcome. This episode covers the various alternatives and recommendations to create a system to measure the performance of a corporate venture capital program. If you find this information useful, I encourage you to like the video, share your comments, and check out the other articles I've written published both on LinkedIn and on Medium. So if your company is considering forming a new corporate venture capital program, the topic of measurement is going to be raised and likely debated. I've created this video to help new CVCs or fund managers articulate a system that can provide your stakeholders and leadership teams with the necessary information while balancing the long-term investment horizons that accompany venture investment. There are generally three metric categories that we use to evaluate the performance of a CVC or a venture program. Those are strategic, cultural, and financial. Strategic metrics capture the degree to which the investment achieves some specific and stated strategic objectives. These metrics are the most subjective, often qualitative, and can be the subject of heated debates. A key issue with strategic metrics is the concept of attribution. So is the achievement of the strategic objective attributed to this investment? To what degree? Would the objective have been achieved regardless of the investment? And did the objective fail to be achieved because of some external factors to the investment? Strategic objectives could include such things as creating a pipeline of acquisition opportunities or leveraging learnings from new startups and emerging fields to help inform a company's own internal build efforts. Cultural metrics are slightly less subjective. However, they're still very qualitative, or often qualitative, and difficult to measure with any sense of precision. So investments may be made to position the company as being perceived externally as a bit more forward-thinking or innovative, perhaps in an effort to bolster external recruiting efforts or maybe shore up some internal retention metrics. And financial, the strong default for most owners, shareholders, or management teams is to revert to somewhat objective, quantitative financial metrics. Return on invested capital, internal rates of return, exit to investment ratios, etc., all provide a perception of precision and can appear less subjective than either strategic or cultural metrics. One could make a pretty strong argument that strategic and cultural objectives are simply financial objectives in the long run. However, the issue arises due to the fundamental difference in financial performance profiles between venture investments and the operations of the business. Even in those organizations that are routinely investing in organic or inorganic growth, such as acquisitions or alliances, the risk profile and investment horizon are so vastly different that comparability issues are typically present. So now let's compare the metrics traditionally used by independent venture capital firms. So the traditional independent venture capital firm makes investments primarily for the purpose of achieving capital appreciation. Well, this has changed significantly in the last few years with firms blurring the lines between incubators, accelerators, and minority equity investments. The firms continue to be primarily evaluated based on financial performance. So metrics such as multiple on invested capital, internal rate of return, exit to investment ratios are commonly touted when firms are raising funds or competing for limited partners. And in today's environment, the number of unicorns that are either currently or previously held is another important indicator of a fund manager's capability. The issue with comparing any financial metric of a CVC to an independent venture capital firm is that each approaches the investment process differently, with different objectives and with different definitions of success. While the number of unicorns is important to consider when you're a potential limited partner seeking a fund manager, it becomes much less so when considering whether a business unit within a professional services organization, for example, should allocate capital to a CVC team. Any firm would love to brag about their internal CVC team being in on the ground floor of the next big sensation. The real evaluation, though, should center on whether or not the investment provided the rest of the business with tangible benefits, whether it was pull-through service revenue or enhanced relationship at the C-suite of clients, etc. Another additional comparison challenge is that a CVC is likely to be following the lead of more established venture capital firms. While it's not always the case, a CVC manager can rely on the network, reach, and due diligence capabilities of the so-called smart money funds. And so what ends up happening is the identification risk and the execution risk is transferred from the CVC to the VC, providing bias in the financial metrics and potentially overstating the performance of a CVC fund manager. And finally, the issue of success is very different between an IVC or an independent venture capital firm and a CVC. For venture capital firms or IVCs, success comes from exiting the investment and recording a profit, whether the exit's through a tender offer of its shares or through an initial public offering. The VC can claim success and increase its exit to investment ratio by harvesting its investments and pushing for such exits. The CVC, however, may view success much differently, and in fact, may view such exits negatively, as it may mean the end to a beneficial partnership, especially if the portfolio company is sold to a competitor. To be pragmatic, any CVC is going to have to be measured using financial metrics in some form. So the objective shouldn't be to avoid these metrics, but rather avoid the false comparisons with independent venture capital firms and other pure financial investors. Internally, firms are likely to group investments in CVC with other internal development or build, acquisition or buy, and partnership or ally efforts. Of course, this makes sense as all four are related to growth. However, the challenge is avoiding some of the comparison errors that we just discussed. So for build, internal development or build efforts are likely to be capital intensive and span multiple years. The payback from internal development efforts can span multiple years after go live and can be difficult to measure, especially when the end result in a product or service, or the end result is a product or service that replaces a similar and existing product or service. Since these efforts often involve internal and external developers or consultants, the expenses are often aggregated and compared to the perceived increase in revenue to give you a metric, or perhaps the offsetting of declining revenue. Unlike internal build or development efforts, a CVC or a venture investment itself is not an expense. And most importantly, a well-designed CVC process can actually help reduce the build cost. The CVC portfolio can be an early indicator of trends that could materially impact internal development strategies. And the lessons that are learned from the entrepreneurs running these portfolio companies can help internal teams make more informed decisions about their technology platforms, emerging tools, recruiting, hiring practices, etc. The goal is to use the CVC to help reduce both the cost and the time to develop the internal build teams. Buy, most directly comparable, perhaps, is an acquisition or a buy, since it's fundamentally similar to an investment in the equity or assets of another entity. However, often a firm is going to use an acquisition to achieve some near-term or Horizon 1 H1 objectives. Filling a particular gap in a service offering or achieving scale of an existing service line are typically the rationales that you're going to see for acquiring companies. And while some companies may acquire companies that are only likely to be valuable in the mid to long term, say H2 or Horizon 3, it's much more likely that an acquisition business case is going to be based on the financial case of an investment becoming accretive over the near term. And investments in a CVC that focus on emerging technology, however, are going to be unlikely to provide any near-term benefits to the business. These portfolio companies may not be enterprise ready or even Okay, it could be pre-revenue or even pre-client, and lack the sophistication of an operating company or an enterprise-ready company. So while an acquisition may achieve some near-term strategic, cultural, or financial metrics, it's unwise to compare such metrics to a CVC. Over a long enough time horizon, the two metrics may become comparable, but any comparison over the short period of time, especially in the first 5 years of a CVC or a CVC fund, would result in overestimating the impact of the acquisition and not fully capturing the true impact of the CVC. And finally, alliances. Alliances are often tracked using financial metrics such as influence revenue, service pull-through, or perhaps analyst rankings. And while an alliance or a partnership can increase all of these, it's important to remember that the expense of running an alliance is commensurate with the nature of how the relationship is managed and the benefit to both parties. In a case of two equal parties, the long-term benefit of the alliance may have a ceiling due to the lack of majority control or future competing interest. In the case where one party clearly has a position of strength in relation to the other party, I'd expect to find that weaker party to have a much lower ceiling and therefore lower cost. The difference, and this is different than the relationship with the CVC and the entrepreneur. And while there's clearly one's operating from a position of strength, that's the CVC, the benefit to both parties, being both the company and the entrepreneur, is potentially much higher than a traditional alliance. And this is expected, or I would expect this, because the risk to both parties is also materially greater. The potential pitfall is comparing the near-term performance of the alliance with any one particular portfolio company. While the alliance may appear more financially rewarding than any one particular investment, the real comparison is in the potential benefit of the portfolio of the CVC as compared to the benefit of a particular alliance. Considered in this light, the CVC may be riskier, however, the potential benefit is also much greater as a percentage of the invested capital. So finally, what are my recommendations? Well, comparisons to an independent venture capital firm or internal build, buy, or rely alternatives is interesting and will need to be clearly articulated and explained for management and for shareholders. It leaves us with what are the metrics that we need to use to actually measure the real performance of the CVC. I'd recommend keeping the list of metrics short. Less is more. And I'd recommend focusing on these 5 metrics. First, the primaries. And each of these 3 are strategic metrics. Quality and quantity of the connection points between the portfolio company and the business. Portfolio balance as measured by adherence to the objectives of the portfolio as clearly stated in the beginning, and that could be investment themes, it could be horizons, it could be verticals, or it could even be horizontals. And the number of qualified acquisition pipeline candidates that are created. And this is especially true if your company is acquisitive or looking to use the CVC to help better inform its acquisition strategy. The secondary objectives, both are financial. Both of these are measured at the fund level. And the first is multiple on invested capital, and the second is the internal rate of return. It's important that both of those be measured at the fund level, though, and not the individual investment level. The typical challenge to the primary metrics above these 3 strategics is that they're subjective and qualitative in nature. And while this is true, the intent here is not to measure decimal place precision, but rather use these metrics as a tool to help drive behavior. Any measurement system is going to have an impact on the behavior of both the CVC and the business. And by delivering the message that these metrics, these 3 strategic metrics are important, the entity as a whole will focus on the activities that are beneficial to the long-term success of the business by sharing ideas, engaging with market disruptors, as well as the CVC by leveraging the network of the firm to help the entrepreneurs. So I appreciate your time. I hope you found this useful, and certainly I would appreciate it if you'd please leave any questions or comments below the video. Thank you very much.